Selling cash secured put options. It's something I do every month to make me a little bit of extra money. On this channel, it's something I've talked about quite regularly in my passive income updates. And when I talk about it, I realize that it can sound very confusing, very abstract, but that's not necessarily the case. And that's what this video is going to be about today. None of this is financial advice whatsoever. What you want to do with your money is completely up to you. I'm just going to tell you what I do with my money. And yeah, who knows, you might find this video useful and it might give you an idea or two about what you might want to do with your money. So let's get into the basics first. In order to completely understand what selling cash secured put options means and what it does for you, how it can generate money for you, first of all, you actually need to understand what options contracts really are. Options contracts, in their most basic sense, are simply an agreement between two people about a future price. A promise about what might happen to a stock's price by a certain date and what you have to do by the end of that certain date as well. Now, maybe you've heard of trading options before and you've kind of assumed that they're only for people trying to gamble on stock prices that are swinging up and down really fast. That is one way to use them. It's a pretty dangerous way to use them in my opinion, but it's not the only way to use them. There are two kinds of options contracts. The first is called a call option. A call option is a contract about buying a stock at a set price. And there is a put option. A put option is a contract about selling a stock at a certain price. Let's talk a little bit more about what put options really are. A put option gives someone the right to sell a stock at a certain price by a set date. Here's the part that matters though. You can be on either side of that contract. You can buy a put option, in which case you pay for the right to sell a stock at a set price. People do this to protect a stock they own. It's kind of like buying insurance. Or you can sell a put option, which is what I'm going to be talking about more here, meaning that you are on the other end of that insurance, which means you're agreeing that if the person wants to sell their stock at that particular price, you will buy it. And in exchange for taking on that agreement, you get paid cash up front. And this is what I've been doing each month to generate a little bit of extra income. Selling put options, or more specifically, selling cash secured put options. That basically means I have set my own cash aside just in case I become obligated by the end of a contract to buy a bunch of shares. This will be much easier, of course, to understand through an example. So let me take you back to the month of May where I sold my very first cash secured put with real money. Prior to that, for several months, I'd been practicing how to do this using what's called a paper account, where you basically just trade fake money. Now, in order to get started selling cash secured puts, you have to find a company that you would be very happy to own shares in. I made a trade on a company called SoFi. SoFi is a US-based online bank and fintech company. It's a company that I'd been watching for several months and doing practice trades on in that paper account I mentioned earlier. Basically, I like the look of SoFi and I considered I'd be very happy to own shares in that company. So back in May, I jumped into my brokerage account and I went into what's called the options market for the company SoFi. The options trading market can look quite intimidating. At first, it's a big wall of numbers, prices all over the place. All it is a screen where you have two sides. On one side of the screen, you have all of the call options laid out, all of the prices they're trading at. And on the other side of the screen, you have all of the put options laid out, all of the prices that they're trading for also. Now, at the time, the company SoFi, their share price was typically around the $15 to $16 mark each day. And what I'd done beforehand was I'd spent quite a bit of time researching the highs and lows over the past 12 months that the share price was trading at. And what I'd noticed was that in the 12-month period, it had traded at a low of around about $14 or just below $14. And the highest it ever got inside 12 months was around about $22, $23. But it was always averaging at a price of about between $16 to $18. So I figured that the chances of it going below $14 are quite low. So When I was looking for an options contract to sell, I had that in mind. I knew that currently SoFi was trading at about $15, almost $16 per share. And I figured that it's not a bad price, but I would like to buy it a bit cheaper than that. I found a contract that would let me buy SoFi shares for $14.50 per share. I also need to mention here that options contracts are always for 100 shares a piece, 100 shares a contract. So I found this contract that looked really good. And what made it attractive? There are three core numbers, three things about this contract, about any contract, that make it attractive. One is the strike price, the other is the duration, and the other is the premium price, which is how much that contract is worth, the value of that contract. Let's talk about the strike price. Strike price is basically the price that you agree to buy or sell shares at the end of a contract. In this case, this contract strike price was $14.50 per share. That brings us to the duration. This contract's duration was 31 days. So by the end of 31 days, the end of that contract, if the price of SoFi's stock was at exactly $14.50 a share or less, I then have to buy 100 shares at that price of $14.50. The other really important number about the contract that you need to know as well is the premium, the actual value of the contract itself. This contract was worth 60 cents a share. Doesn't sound like a lot, but remember, we're talking about 100 shares here for one contract. So when I sold the contract, I collected 60 cents times 100. Which of course was $60. So to recap all of that, that first cash secured put that I had sold, it was a promise that I would buy 100 shares of SoFi at the price of $14.50 by the end of 31 days. Now you might be thinking, what's the point of all this? Why just pick up $60 for selling this one contract if 31 days later, you're gonna have to pay $1,450 to buy 100 of these shares? Well, you do it because you may not actually have to buy the shares at all. Let's have a look at some of the outcomes now. Let's look at outcome number one, which is pretty simple, really. That is the outcome where by the end of 31 days, SoFi's share price is above $14.50, in which case, nothing happens at all. The contract expires and I have walked away with $60 profit. Nice. So then there's outcome number two, which of course is kind of the opposite of that. It's when the strike price by the end of 31 days has hit exactly $14.50 per share or gone below that. Now it might be slightly below that, could be well below that, but the point is it's below the strike price, which now means I must buy 100 shares of SoFi at the agreed price in the contract, which was $14.50 per share. So now I'm gonna spend a total of $1,450 buying those 100 shares. And I've also kept that $60 that I earned right at the start for selling the premium. So really, I've actually bought those 100 shares for a total of $1,390 when you think about it, because, you know, 1,450 minus 60 equals 1,390. Right from the start, that's a scenario I would be happy with. Remember, it's very important that you sell cash secured put options on companies that you are happy to own shares in. Now that you own 100 shares, you could go the other way. You could actually sell what's called call options on these 100 shares that you own. It's basically the reverse of what you just did selling the put option. Now you're gonna enter a contract to agree to sell the shares at a particular price by a particular date, and you're gonna collect another premium for that. That's another story though. Now we do need to discuss risks, of course. That second scenario that I just explained to you, where you ended up having to buy the 100 shares, what can happen in this scenario, of course, is that the company's share price doesn't just go a little bit below the strike price at the end of the contract, it goes well below, in which case you end up having to buy that stock at a particular price, which is well above what the stock is currently trading at. So yeah, that's a serious risk to consider. However, if you do your research, I looked at the highest price and the lowest prices it had reached in the past 12 months and determined that there's a pretty low chance of it actually going beyond this particular price. And that has been the case to date. Doesn't mean it won't happen, but it's a lot less likely to happen to you if you've done your research beforehand and you figured out the ranges that that stock trades at typically. Now here's an interesting thing also. That example I gave you of my very first cash secured put that I sold back in May, I actually didn't wait the full 31 days for the contract to expire. What ended up happening was about a week or so after I sold the contract and I collected $60 for selling that contract, the value of SoFi's share price rose quite a bit. And of course, there's two things that makes the value of an options contract decay, that is time, or if the share price is getting really quite far away from that strike price that you have to meet at the end of the contract. And that's exactly what happened. SoFi shot up to, I think it was about $19 per share, and I had a strike price on that contract of $14.50, which meant that the value of the contract that I'd sold was just plummeting in value, and it was trading at something like 20 cents just after a week after selling it. So I just bought the contract back. You can totally do that. Remember that I had sold the contract initially for a price of 60 cents per share, times that by 100, I get $60. And just about a week or so later, price of SoFi shoots right up. And now the contract's only worth 20 cents. So yeah, I just bought the contract. And what that does, it cancels the whole thing completely. End of deal. So in just a week or so, I had made $40 profit, and I did it all again. I looked for another options contract to sell, repeated the process, and actually had a very similar outcome. And that's how you can generate money selling cash secured put options. So you've probably figured by now that this isn't free money. You need real cash set aside, ready to actually buy the stock if it comes to that. And you do need to actually want that stock, not just chase the premium. If you wouldn't want to own it anyway, don't sell the put option on it. The thing I really like about selling cash secured put options as a strategy for earning a little bit of extra money each month is that, one, it's relatively easy. It's a lot easier than, say, doing manual labor, for instance. And two, it's that I'm getting paid to just sit and wait. Once I sell a cash secured put, all I have to do is just wait and see what happens. Wait for the end of that contract, or maybe even earlier. But yeah, just earning a little bit of money for sitting around waiting is pretty cool to me. So there you have it. There is my definition of what selling cash secured put options is, how it can make you a little bit of extra money if you do it. Could lose you money as well. Be careful, do your research before you go into any of this. And I will say again, none of this is financial advice. It's just what I do with my money. No pun intended, but selling cash secured put options fits in quite nicely with the whole notion of this channel, life with options. I'm selling options, and it's one of the options I have to make more money. Is selling cash secured put options something you've thought about doing? If so, was this video useful for you? Let me know in the comments. Actually, let me know in the comments even if it wasn't useful for you, because it gives me an idea of how I could maybe better explain the whole concept in the future. But yeah, thanks for watching.